Okay. Good morning, everyone. I hope everybody has joined in. Uh, I can wait for a minute so that whoever is still in process of joining can join so that we can start after 1 minute. Good morning, Shailesh. I saw you pinged on the chat box. Good morning, Viraj, Manisha, Vanshika. Good morning, Muftika, Prachiti. Okay. So I hope by now everybody has joined in. So we can start with today's session. Uh, we will be talking about India's 102 share-based payments. So that is the topic of the day. And uh, let's start as usual with the scope because scope is very important. We need to understand what the standard covers and what the standard does not cover. So that is very important to understand first. Thereafter, I will come to the key terms defined by the standard or key terminologies which we need to understand in order to understand the intent and objective of the standard. Okay. So what is the scope? Scope share-based payment transactions. So these are share-based payment transactions. So any transaction which involves payments based on the shares of the company. Okay. So if there is any transaction which involves payment to the other party by the company in the form of equity shares of the company or in the form of cash or other asset determined basis on the shares of the company, right? So share based payment transactions include grants to employees, right? So employees, are sometimes you must have seen that given the share options, okay, in the company. So there are certain conditions attached to those plans. Those plans are called employee stock option plans, ESOPs, okay, in general. So under those plans, companies attach certain conditions like employees are continued with the companies for 3 years, 5 years, 7 years, whatever the term company, wants them to retain with them. So if they fulfill that service condition, so those employees will certain number of shares of the company upon completion of that period with the company, right? So those are literally called ESOPs, employee stock option plans. There might be certain additional conditions apart from, continuing with the company, like performances of the employees, performance of the company, or whatever. Any other conditions may also be there which needs to be fulfilled, right? So we will study all those conditions in detail, what impact of those conditions, in what scenario if condition fails, then what we will be doing if condition, doesn't fail, then how the recognition happens. So all those, concepts we will study going forward. But just to set the context for the standard, share-based payment includes grants to employees, then grants to non-employees. Okay. So employees we understood because we have heard about this, before as well, in Indian GAAP as well, whenever we were, using the guidance note on the ESOPs issued by the Institute Chartered Accountants of India under IGAP. But now there are one more aspects covered: grants issued to non-employees. So if there are any third parties who are supplying goods or any sort of services to the company, for example, suppliers, lawyers, or any other party who is selling anything to the organization, maybe machinery, maybe building, maybe land, whatever. And if company decides to discharge the obligation to that party in the form of shares or in the form of cash or other assets determined basis on the shares of the company, right? So those grants will also be covered within the scope of this standard. So grants to employees as well as grants to other third parties or non-employees, both are covered, right? Employee share purchase plans. So this is another type of plan where company enters into a contract with the employees or non-employees that company will purchase the shares from them. Certain share-based payments settled by an entity in or an external shareholder of the same group. Sometimes it happens that holding company discharges the obligation of the subsidiary company and vice versa, right? So within the same group, if holding company discharges the obligation on behalf of their subsidiary company, or subsidiary company discharges the obligation on behalf of their holding company in the form of shares or in the form of cash or other assets, right? Then that transaction will also be covered within the scope of the standard. So this is the scope, and we will of course do lots of practicals as well as examples for all these concepts. Just a basic understanding: number one, grants to employees; number two, grants to non-employees; number three, employee share purchase plans; and number four, certain share-based payments settled by company or subsidiary company or any external shareholder of same group on behalf of any of the group companies within the same group, right? So these are the four items which are covered within the scope of the standard. Now there are certain exclusions as well. What are those? Standard does not apply to the transactions with shareholders in their capacity as such. For example, issue of equity shares. So whenever company gets listed on the stock exchange, they come with the initial public offer. If the company is already listed on the stock exchange, they may come up with the further public offer. They may come up with the private placement of equity shares to the investors. Okay. They may come up with the bonus issue of shares. They may come up with the right issue of shares. So all these things, all these transactions are not covered within the scope of this standard, because all these shares are issued to the third party in capacity of shareholders, right? Because in case of IPO, company issues equity shares and collects cash from the investors, right? And those investors are not providing any goods or service to the company. Rather, they are actually investing in the shares of the company, right? So they are becoming investors of the company. They are not supplying any goods or services. So these transactions are purely in the capacity of the shareholders. Hence, these transactions are excluded from the scope of the standard. So IPO excluded, FPO, further public offer, is also excluded, right issue is also excluded, bonus issue is also excluded, private placement of shares, right, to selected class of investors. So all these transactions are, being done in the capacity of the shareholders. So these are excluded from the scope of this standard. Next item, share issued in business combinations. So I'm not sure if you have studied standard India's 103 business combinations. So under that standard, whenever a company acquires another company, for example, A Limited is acquiring B Limited. So A Limited is the acquirer company, B Limited is the acquiring company, which is being acquired by A Limited. So if A Limited pays the consideration, PC, purchase consideration, in the form of issue of its own equity shares, right? So those transactions are specifically, accounted for in accordance with the guidelines of Ind AS 103, right? Ind AS 103. So because we have a specific standard to talk about all the accounting, measurement, recognition, and disclosure requirements of these business combination transactions, so Ind AS 102 has excluded those transactions from its own scope, right? Because 103 is the specific standard covering all such transactions. So if any shares are issued to the acquiree or owners of the acquiry company by the acquirer, then those transactions are accounted for in accordance with Ind AS 103 and they are not covered under Ind AS 102 share-based payments. That is clear. Third exclusion is transactions in scope of Ind AS 32 and Ind AS 109. So if there are any transactions which are in the scope of Ind AS 32 and Ind AS 109, then those are also excluded. So for example, if we issue equity shares, for example, further public offer, right issue. So all these transactions are issuance of securities and, covered under Ind AS 109 financial instruments. So again, that, is not covered. So if there are any transactions which are accounted for in accordance with financial instrument standard, Ind AS 109, then those are excluded from the scope of the standard. So I give you an example. For example, sometimes, companies purchases commodities on the MCX and, they intend to settle the contract net. For example, if somebody is buying gold, silver, or any other commodities on the exchange in the forward or future contracts, so those are derivatives, basically dealt under Ind AS 109. And the intention to settle those contracts is on net basis rather than taking delivery for the business purposes, right? So whatever is the gain or loss is being, settled on a net basis because the contracts have been taken with an intention to gain from the price appreciation. That is a trading activity in the derivatives, right? So all those transactions are covered under Ind AS 109 and 32. So those are not, covered under Ind AS 102 share-based payments. So Shruti is asking, grants to employees can be given by anyone, including government also, or by government ones will be covered under Ind AS 20. See, if grants are being given by any external party to the group, so those are not covered because what we have studied here is under Ind AS 102, holding company can grant on the behalf of subsidiary company or subsidiary company can grant on the behalf of holding company or a external shareholder of the same group can grant on the behalf of holding company or the subsidiary company, like shareholders of the parent company. Okay. But government cannot come into this picture. So government is a separate altogether separate party. So they are not falling in the same group. Had it been a government company, for example, ONGC or other government companies like State Bank of India. So if these companies are giving grants to their own employees, then again for them Ind AS 102 will apply. So government cannot come and grant shares of Reliance Industries to the employees of Reliance Industries, right? So that is not the transaction, can happen practically. And even if it is happening, then it cannot be covered under Ind AS 102. I hope I cleared your doubt, Shruti. Okay. So now we will proceed to discuss about key terms first. So there are key terms which will be used in the standards. So let's talk about one by one. Exercise period. The period during which options can be exercised and shares can be purchased, right? So suppose if a company has given employee stock option plan to the employees with a condition attached, if employees remain in employment with the company for next 3 years, then he will be entitled to 100 shares of the company. Okay. Now, this 3 years is the vesting period over which the shares will vest, or employee will become, entitled to claim those shares. So this 3 years period is the vesting period. Now, once the 3 year period is complete, then there is a say 6 months period after that, once the employee has become entitled to claim, that they can claim these shares within next 6 months when the vesting period is over, which is 3 years, right? So if employee claims or exercises those shares, because now he can ask the company that I have completed the 3 years with your organization, now please credit 100 shares to my demat account, right? So if he claims those within the exercise period, which is 6 months after the vesting period is over in this example, then that period of 6 months would be regarded as exercise period. So exercise period is the period in which employee can claim the shares from the company which he has earned by complying the condition of continuing with the company for 3 years, which was the vesting condition for the plan, right? So an employee who leaves the company during the exercise period will still be entitled to the options. So for example, if employee has completed 3 years with the organization, now he has earned the right to claim 100 shares. Now after completing 3 years and after earning this right, he decides to resign with the company. So even then, because he has completed the vesting condition, he will be eligible to claim those 100 shares from the company, right? Because he has completed the vesting period and he has resigned after the vesting period is over, right? Fair value. You must have heard that there is a separate fair value standard, Ind AS 113, fair value measurement, which tells you how to determine the fair value, right? For assets, liabilities, whichever, are to be accounted for by any other standard. But under Ind AS 102, this standard has its own fair value definition. Okay. Now, because this standard has its own fair value definition, so Ind AS 113 will not apply on any of the transactions covered under Ind AS 102, right? And what that definition is: the amount for which an asset could be exchanged, a liability settled, or an equity instrument granted could be exchanged between knowledgeable willing parties in an arm's length transaction. So this is the definition given by the Ind AS 102 for the fair value. So fair value definition for the purposes of Ind AS 102 is defined by this standard only. Hence, a fair value measurement standard Ind AS 113 will not apply in this case. So this standard uses the term fair value in a way that differs in some aspects from the definition of the fair value in Ind AS 113. Therefore, when applying Ind AS 102, an entity measures the fair value in accordance with this standard and not Ind AS 113. So 113 will not apply to the transactions covered under Ind AS 103 for the purposes of determination of the fair value, right? So 113 is completely out of picture for the transactions covered under Ind AS 102, right? Neither the measurement requirements nor the disclosure requirements of 113 will apply. Okay. Intrinsic value. So the difference between the fair value of the shares and the price required to pay for those shares. So fair value is determined in accordance with Ind AS 102. And if the company says, okay, we will grant you 100 shares say company saying to its employees that we will grant you 100 shares at the end of the 3 years, but you have to pay 15 rupees per share on that date whenever you exercise. So exercise price is determined at 15 rupees per share, and shares fair value is rupees 20. So 20 rupees fair value share is being given by the company to its employees at rupees 15. So 5 rupees is the discount involved in this case, which is a benefit to the employee. So 15 rupees is the exercise price of the shares, and 20 rupees is the fair value determined under India's 102 as above. Then 5 rupees, which is a benefit to the employee, it will be regarded as an intrinsic value of the option or the share, right? So 5 rupees will be the intrinsic value. So intrinsic value is not allowed for the accounting of share-based payments under India's 102. So under IGAP, guidance note was allowing to, record the transactions at intrinsic value, but India's 102 does not allow to do the accounting at intrinsic value. It requires the accounting has to be done at fair value only, right? So Mr. Muhammad is asking, sir, in the Vodafone case where AGR dues are settled by issuing shares, will that be covered? So if there is any liability which is being discharged by issue of shares, right? So I'm issuing shares for discharging a existing liability in my balance sheet. So as such, that transaction should be covered under India's 102 because that is being share-based payment, right? But in this case, because this is a government dues which has been discharged, we need to see what are the other terms and conditions attached to that, because government has, intention to take the ownership of the company, right? 33%, one-third ownership government has taken, right? So that, circumstances we need to check. But yes, if we, discharge any liability by issuing equity shares, so those will be regarded as share-based payments. Now, what is the vesting? Vest means shares vested to employee, means employee becomes entitled to ask or demand the shares from the company. Vest means whenever the employee or the other party gets the right to, claim those shares. So vest means to become an entitlement. So whenever the other party, employee or non-employee, becomes, entitled to claim the shares from the company after satisfying all the conditions, in the contract by the company, then it is regarded as vested happens. Under share-based payments, a counterparty's right to receive cash or other assets, equity, instruments of the entity vest when the counterparty's set entitlement is no longer conditional on satisfaction of any vesting conditions. So if there are no more conditions left to be complied with, shares are regarded as vested. That is, other party now can demand the shares from the company. Vesting period. The period during which all the specified vesting conditions of a share-based payment arrangement are to be satisfied by the employees or the non-employees, as the case may be, right? So vesting period is, say, 3 years in our example, when the company said to all of its employees that if you continue with the company for next 3 years, we will give you 100 shares of the company after the completion of 3 years, right? So whoever, has continued with the company for 3 years will become entitled to claim these shares. So this 3-year period will be regarded as the vesting period, right? Because the condition says 3 years employment with the company. So vesting period will be 3 years. Vesting condition. It determines whether the entity receives the services that entitle the counterparty to receive cash or other assets, equity instruments of the entity under the share-based payment arrangement, SBPA, share-based payment arrangement. Okay. Now, vesting condition. Like I have given example that company asked employees to continue with the company for 3 years, right? So three continuation in employment for 3 years is the condition which needs to be complied by the employee in order to claim the shares, right? So that will be regarded as a vesting condition, because if any employee resigns, from the company before the completion of 3 years, he will not be entitled to the shares, right? So that is the vesting condition. Apart from this service condition, there might be certain additional conditions, casted on the employees. For example, performance related conditions, that you have to be, a good performing employee throughout the 3 years period. There shouldn't be any, behavioral issues. So whatever other conditions can be attached. Or for example, performance of the company. So if revenue of the company grows by 10% each year, right, for next 3 years, then, employees will be given. So two conditions. First, employee needs to be with the company for next 3 years, plus revenue of the company should grow at least by 10% each year for next 3 years. So if both the conditions get satisfied, then only employees will get the shares, right? So in that case, there are two conditions. One is the service condition, that is continuity of employment for 3 years. Another is performance condition, that is revenue growth of the company for next 3 years by 10% minimum, right? So combination of these service condition plus performance condition will be regarded as vesting conditions, because both the conditions needs to be complied within a period of 3 years, which is a vesting period. So both the conditions will fall within the definition of vesting condition, although they are different in the nature, right? One is related to the employee continuation, that is service condition. Another is related to the performance of the company, right? So that is a performance condition. Any doubts on any of the definitions? I am happy to take up your queries on this. Okay. No questions. So let's understand the meaning of share-based payment arrangement. Now, so far, we have understood the scope and the key terms which will be used throughout the discussion, during the session. Now, what share-based payment arrangement means? Because that is the key definition which we need to understand, because the whole standard revolves around this share-based payment arrangement only, right? Share-based payment arrangement, SBPA. It is an agreement between two parties. Party one is the entity, that is the company, right? The entity, or any other group company within the same group, like holding company or subsidiary company within the same group, or any other shareholder of that group entity. So shareholder of a parent company or shareholder of the subsidiary company, right? So these are regarded as party one to the agreement. So it can be either the company itself, it can be the parent or subsidiary of the company, or it can be any other shareholder of the company, right? So these are the three parties which will be regarded as party one to the contract. Now, who is the party two? The other side. That is the another party. For example, an employee or an supplier of the property, plant and equipment, or the raw material or the services, for example, lawyers or any other party, whoever is, supplying any sort of goods or services to the company. So another party could be either employee or non-employee, right? Employee or non-employee. Correct? Now, this agreement, when entered between the party 1 and the party 2, entitles the other party means this party 2, to receive cash or other assets of the entity for amounts based on the price or value of the equity instruments, including shares or share options of the entity or another group entity. So this second party, that is employee or the non-employee, will get either the shares of the company or the shares of its holding or subsidiary company, or the cash calculated basis on the shares of the company or of the parent or the subsidiary company, right? Or if he receives the equity instruments, including share or share options of the entity or another group entity. So either he will be receiving the cash or he will be receiving the equity shares, right? If he receives the cash, then how much cash he will get will be determined basis on the shares of the company or of the group company. Or if he receives the shares, then shares can be of the company or of the group company, right? Provided the specified vesting conditions, if any, are met. For example, in case of employee, there might be a condition of 3 years plus, performance condition. So both the conditions needs to be met. In case of other party, goods and services of a, acceptable quality must have been supplied by that party to the company. So those will be the vesting conditions in our example. So what is the share-based payment arrangement? Share-based payment arrangement is an agreement between the two parties, right? First party is the company or the group company or the shareholder of the group company, right? Second party is the employee or the non-employee, with whom the company has entered into a contract to buy the goods or services, right? Now, other party will receive either cash or shares. If he receives cash, then how much cash will he will receive may be determined basis on the shares of the company or shares of the group company. And if he receives shares, then those shares can be of the company or of the group company, right? Provided vesting conditions are satisfied. So this is the share-based payment arrangement. For example, there is a group Tata Sons. Okay. Now Tata Sons is the ultimate parent company of all the Tata Group companies. For example, Tata Consultancy Services, Tata Motors, Tata Steel, Tata Telecommunication. So all these companies are, within the same group, and Tata Sons is the ultimate parent for all these companies. So this is regarded as a group. Now, if there are employees of Tata Steel, for example, now employees are the second party and Tata Steel is the first party. Now, Tata Steel says to its employees that we will give you the shares of the company, maybe of Tata Steel or of another company, maybe of Tata Consultancy or Tata Telecommunication. So employees are employed with the Tata Steel. Tata Steel will be giving the shares to its own employees, but shares, instead of giving of Tata Steel, this company may also give the shares of another group company, for example, Tata Motors or, Tata Consultancy. So that is the transaction on share-based payment of the group entity. If Tata Steel issues shares of its own company, that is Tata Steel shares only, then it will be the transaction based on the shares of own company. So both the transactions are covered. If otherwise, Tata Steel says that, okay, we will not give you the shares, but we will give you the cash after the completion of 3 years. And that cash will be determined basis on the price of the shares on that date, right? So after 3 years, whatever would be the price of our company, say Tata Steel, we will give you a cash equivalent to that price multiplied by 100, because we have agreed to give you 100 share options. So in that case, what will happen? Tata Steel is discharging the obligation in cash after 3 years, determined basis on the price of the Tata Steel's own shares after 3 years. Or what is the another option? Tata Steel may say, okay, we will give you cash, which will be determined basis on the share price of the Tata Consultancy after 3 years. So both the transactions are covered, right? So either the party one can discharge the obligation in shares of its own company or in shares of any of the group company, or otherwise it can discharge the obligation in cash determined basis on the share price of its own company, or in cash determined basis on the share price of the group company. So all these four transactions are well covered within the share-based payment arrangement. Any doubts on the understanding of this arrangement or any query? No questions? Shall I proceed? Okay. Share-based payment should be formed with an agreement between an entity and a party, including employee, which essentially means that a communication of the terms and conditions should be in place in order to have share-based payment. Now, whenever we say that there is an agreement between the two parties, so agreement between two parties means that agreement has been signed by both the parties who are agreeing to the terms and conditions of that agreement, right? So that is the general understanding. If two parties agree to the terms and conditions, then only they will sign the agreement. Otherwise, they will not sign. So once they sign, the agreement is, concluded that this is the plan or agreed terms and conditions. Now, same applies to the share-based payment as well. So whenever company launches or announces any employee stock option plan, okay, now, so as such company doesn't get, the signing of the employees that, okay, you are agreeing to participate in the ESOP or not, right? So it is a general announcement made by the company for all of its employees that whoever, complies with the conditions annexed therein will be eligible to claim the shares, right? So that is a general, plan for all of its employees. Now, even in that case, we need to, be careful whether that announcement has been made by the company to all of its employees, and employees knows that they, got this ESOP plan from the company, and they are now, aware of the terms and conditions of that plan, right? So if that understanding is there, that company has, discharged its duties by announcing the plan, and employees have, understood the terms and conditions of that plan, then only we can say that this is a share-based payment plan between the company and its employees. If employees are not aware, or employees have, contested that we are not, accepting this plan, then that cannot be regarded as a share-based payment plan. Now, what actions of the company will, be enough to say that company has, announced the plan successfully and it is, deemed accepted by the employees. So for example, if there is a factory and there is a bulletin board, on which all the announcement on a daily basis are sticked by the company. So on that bulletin board, company can attach the share option plan, which they have announced for the factory employees with the terms and conditions. So whenever the factory workers arrives in the morning, they can see that bulletin board and, read whatever the terms and conditions are there, right? That could be one of the action. Another is company can email the terms and conditions of the plan along with all the benefits, what benefits, will be passed on to the employee if they comply with the terms and conditions to all the employees' email IDs. So employees have received that communication. So it will be regarded as that there is an agreement between the two parties, right? So definition requires that two parties should be aware about the terms and conditions which are there, which needs to be satisfied in order to become eligible for the shares under the plan, right? So that is the thing. It does not necessarily require employees to go and sign some sort of document or reply the emails with yes, that yes, we agreed to the terms and conditions and we provide our acknowledgement or acceptance. So that is not the requirement. The requirement is that both parties should have been aware by about the terms and conditions and there is no disagreement, right? So that is the requirement. For example, a management committee of an entity has initiated a plan to provide some stock options to its employees, but there are some terms which are yet to be finalized by the company and the plan is not yet communicated to the employee. Since there is no formal communication stating the terms and conditions of the agreement, it will not attract Ind AS 102 provisions. The standard will be attracted when there will be a binding arrangement. So company is drafting the employee stock option plan. It is almost drafted, but it is not yet finalized by the top management or senior management or approved by the top management or senior management. They are still thinking if they are good to go with the terms and conditions drafted as of now. Hence, because this plan is at draft stage, it is not yet communicated by the company to its employees, right? So neither the plan is approved by the top management nor it is communicated to the employees. So hence there is no share-based payment agreement or arrangement between the company and its employees. Hence Ind AS 102 provisions are not attracted at this stage. So when Ind AS 102 will apply? Ind AS 102 will apply on the date when top management confirms, yes, this plan is okay from our side and communication has been rolled out to all the employees, right? On that date, it will be regarded as share-based payment agreement entered into between the entity and the other party, which is employees in this case, right? So communication to the employees is an important aspect. Any doubts on this? Okay, it's clear. Okay. Now, as I previously mentioned, that there might be a vesting period, right? So this is, the vesting period. For example, this is the date of grant. Grant date means the date at which the entity and the counterparty, that is employees or non-employees, have a shared understanding of the terms and conditions of the arrangement. For example, ESOP is announced on, say, 15th of June 2023 for all of its employees by the company. So 15th June will become the grant date. So grant date is the date when both the parties have understood or become aware about the terms and conditions of the plan. So on 15th June, if company has announced an ESOP plan for all of its employees by sending emails, mass email to all the employees, then 15th June date will be regarded as the grant date. right? So grant date is the date at which the entity and the other party, that is employees or non-employees, as the case may be, understood the terms and conditions of the arrangement or become aware about the terms and conditions of the arrangement and have no objections. Okay. So that is the date regarded as a grant date. Now, if one of the conditions says that employee needs to be continued with the company for next 3 years, then, and if this is the only condition, right? If employee continues with the company for 3 years, then he will be entitled. So there is no other condition. Then in that case, vesting period will be 3 years, year 1, year 2, and year 3. So once third year, that is, if this was say 15th June 2023, then 3 year ends on 14th June 2026, right? So on 14th June 2026, because 3 years are now completed from the grant date, and now whoever employees are still with the organization have the right to demand the shares. So these shares are, vested on this 14th June after the completion of 3 years. So this period will be regarded as the vesting period, right? So this is the period over which the share options or shares will, vest to the employees. So this is the vesting period. So grant date is the announcement date of the plan in layman language, and vesting date is the date on which employee or non-employee receives the right to claim the shares from the company, right? So if on 14th June, employee sends an email to the HR manager that because I have completed 3 years, please grant 100 shares to me as per the plan. So he has become entitled to claim those shares now. So that is called the vesting date. And the period between the two dates is regarded as the vesting period. So vesting period is the period during which all the specified vesting conditions are to be satisfied, right? Now, thereafter, because this is the date on which the shares are vested, so definitely all the employees are not, expected to come and demand the shares on the very same date. So there should be some period allowed by the organization or company for the employees to, apply for the shares or claim their shares, right? So the period between the vesting period and the time which up till which the employee could claim, for example, say 1 year company has given that within the 1 year after the vesting period you should claim, otherwise your claim will lapse, for example. Then for 14th June 2027, right? So this period will be regarded as the exercise period, okay, during which employee can exercise their right to claim the vested shares to them, right? So this will be regarded as the exercise period. And within this period, whatever date at which the employee actually exercises his right will be regarded as the exercise date. So exercise date is the date when the awards, example options, are exercised by the other party, that is employees or non-employee, right? So exercise date may vary for employee to employee or party to party, because some employees may come and ask for the shares on the very same day. Some may come next week, some may come next month, some may come 3 months after that, some may come after 9 months, some may come on the very last day, because exercise period is getting closed on this. If employee doesn't claim by this date, he may lose the right to claim, right? And some may even lose forward to claim. So this period will be regarded as the exercise period, and the various dates on which various employees are claiming their right will be regarded as the exercise date, right? So 3 terms are very important. Number 1, grant date. Number 2, vesting date. and number 3, exercise date, right? And this is regarded as the vesting period, and this is regarded as the exercise period. Just a minute, let me connect to the bed. Okay. Any doubts on this? Any questions, queries you want to ask on any of the key terms we have discussed till now? Because if we understand all the key terms very clearly, then it will be very easy for us to pick up, other concepts and the practical questions. Okay. I think there are no queries. So as we have understood the meaning of the grant date, the date at which the plan is announced and the terms and conditions are, understood by the parties and agreed, right? So grant date is the date at which the entity and the another party, including the employee, agree to the share-based payment arrangement, being when both have a shared understanding of the terms and conditions of the agreement, right? This we have understood, that both parties should have a common or shared understanding of all the terms and conditions of the arrangement. At grant date, entity confers on counterparty the right to cash or other assets or equity instruments of the entity on meeting the vesting conditions. So on the grant date, company agrees that if other party, employee or non-employee, complies with the vesting conditions, then they will be eligible to receive the shares or share options, right? If that agreement is subject to an approval process, for example, by the shareholders of the company, then grant date is the date when the approval is obtained. So if any employee stock option plan which the company wants to announce requires the approval of the shareholders of the company at the annual general meeting or extraordinary general meeting convened for this purpose, then the date on which the approval of shareholders is received by the company on the employee stock option plan will be regarded as the grant date, because company has announced. So suppose, for example, if company has drafted the agreement on say 10th April, okay, then this is the draft. Okay, then board of directors agrees and approves say on 30th of April. Okay. But the approval of shareholders is required. Now, AGM is, held on say 30th September. AGM. Okay. 30th September. Right? And shareholders approve the ESOP plan on this AGM date, 30th September. Then in that case, 30th September will be regarded as the grant date, because on this date only company, has actually got the right to announce the ESOP plan to the employees of the company after getting the approval from the shareholders. So on 30th September, when the shareholders approval is obtained and the plan has been communicated to the employees, then 30th September will be regarded as the grant date. If no such shareholder approval is required and only management approval, that is board of director approval, is required, then 30th April would be the grant date, right? So basis on the facts and circumstances, whatever date is at whatever date there is a shared understanding of the terms and conditions of the arrangement will be regarded as the grant date. And if it requires any sort of separate approvals, that unless and until those approvals are obtained, grant date cannot be started. So grant date will start from the date when such approvals are obtained. Now, since once we understood that this date is the grant date, now we need to do the fair value of the shares which the company will be giving to the employees or the non-employees, as the case may be, right? So there should be certain measurement date as well, on which date fair value of the equity shares needs to be measured, right? So that will be regarded as the measurement date. Now, the date at which the fair value of the equity instruments granted is measured for the purposes of Ind AS 102, right, will be regarded as the measurement date. Now, measurement date will be the grant date in case the transaction is with employees and others providing similar services. So, if the transaction is with employees or other non-employees providing similar services, the measurement date is the grant date. And if the transaction is with parties other than employees and those providing similar services, the measurement date is the date when the entity obtains the goods or the services from the counterparty. So because employees are anyway, being employed by the company already in, the process of delivering services. So as employees deliver the service on a daily basis, because they go to the office on daily basis, work for the company, so services gets delivered, services get delivered on a daily basis, right? So in case of employees, grant date will be the measurement date, because employees are already discharging their services, so grant date will be regarded as the measurement date for determination of the fair value. Now in case of non-employees, because they are raw material supplier, they are other goods supplier, they are property, plant and equipment or machinery supplier, building supplier, or any other items which they are supplying to the company. So unless and until those goods or services are obtained by the company, it cannot be assumed that grant date is started. So grant date will be the date on which such goods or services are supplied by the other party to the company. So that will be the measurement date for determining the fair value of the equity shares which will be issued to these parties, right? Clear? See, if you are getting whatever we are discussing, just write in the chat box it is clear, so that I get to know that you are actively participating. Okay. Determining the fair value of the equity instruments granted. If market prices are available, so in case the company is listed on the stock exchange and the shares of the company are being traded on a daily basis, right? So definitely market prices are available in that case. So measure the fair value of the equity instruments granted at the measurement date, which we just discussed, right? Measurement date based on the market prices if available, taking into account the terms and conditions upon which those equity instruments were granted, right? So market price to available hai hi, so we can pick up the market price, but because market price uh, gives you the fair value of the shares which are freely available for the trade in the market. But employees will get the shares after 3 years only, right? So they do not have the shares on today's date. So there is a waiting period of 3 years for that shares. So in that case, that factor needs to be, adjusted to the fair value, because employees will be able to receive those shares after 3 years, and then only they can, sell it into the market. So the price at which the shares are being quoted in the market today is the price of the shares which are readily available for, disposal. But since employees do not have those shares uh, today, so their fair value would be different as compared to what the price of the shares of the company is there in the stock exchange. So this terms and conditions adjustment has to be made in order to determine the fair value of this share option, right? Because employees do not have the shares as on date, rather they have the option to get the shares. So they have the share option, not the shares. So right, the share fair value of the share cannot be equal to the fair value of the share option, right? So that has to be determined. Even if the market prices of the shares are available, we need to make certain adjustments, right? That can be done by the valuation expert, right? So we can certainly take help of the valuation expert. If market prices are not available, estimate the fair value of the equity instruments granted using the valuation technique to estimate what the price of equity instruments would have been on the measurement date in an arm's length transaction between the knowledgeable and willing parties. So if the shares are not listed, we will definitely get it fair valued by the valuation expert using some valuation techniques. So there are various valuation techniques available, Black-Scholes model, binomial model, and other, techniques are also there to determine the fair value of the share options. So using those techniques, we can determine the fair value, right? If the fair value is not measurable reliably, only in very rare case, then the services are measured at the intrinsic value of the equity instruments. So I previously told that Ind AS 102 does not allow accounting at intrinsic value. It requires accounting at fair value only, right? In the contrast to the guidance note under IGAP. So guidance note under IGAP says fair value or intrinsic value, whatever you can, use for accounting purposes. But under Ind AS 102, intrinsic value is prohibited, to use for the accounting purposes, right? Accounting has to be done only at fair value. But standard now come and says that in only very rare case, when the entity claims that they are not able to determine the fair value of the shares or share option reliably for some XYZ reason, then only in that very rare case, intrinsic value of the equity instruments can be used for the purposes of accounting of these share-based payment arrangements, right? And disclosure why the fair value cannot be determined reliably has to be made. That is a show cause notice disclosure type. So because company is saying that we are not able to determine the fair value, the onus lies on the company to report the rationale behind this claim that they are not able to determine the fair value reliably. So they need to give the reason for that, and then they will state in the disclosure, since fair value cannot be determined for so and so reason, hence we have used the intrinsic value for accounting of the share-based payment arrangements during the year, right? So we have understood the definition of share-based payment arrangement, what it is. We have understood the fact that share-based payment arrangement or agreement is, completed only when both the parties have the shared understanding to the terms and conditions, right? Then we have understood the concept of grant date, that is the date at which the ESOP plan is announced, or shares option plan is announced by the company and understood by the other party, employees or non-employees, then there is a vesting period over which vesting conditions needs to be satisfied. Then there is a vesting date on which these shares are vested to the employees or non-employees, and then there is a exercise period during which employees or non-employees can claim those shares from the company, and there is a exercise date on which actually the employee or non-employee claims the shares from the company, right? So all these terms we have understood. Then we have discussed the fair value, because accounting has to be done at fair value only. Ind AS 102 has its own fair value definition, so Ind AS 113 fair value measurement standard will not apply, right? And fair value has to be determined by reference to the market prices if available. If market prices are not available, then valuation techniques needs to be used, right? And fair value needs to be determined on a particular date, which will be regarded as a measurement date. Measurement date will be the grant date in case the ESOPs or stock options are granted to employees, and measurement date would be the date for non-employees, that is the supplier or consultants to the company, when they actually supplies those goods or renders the services to the company. So on that very date, fair value will be measured. So this is all what we have discussed till now. Before I proceed on the critical aspects of the standard, please let me know if you have any doubts, queries, or concerns till now, whatever we have discussed so far. So Shruti is asking if the service is started for other than employees from 7th July and again on 7th August. So measurement date will be 7th July or latest, that is 7th August. So see, whenever arrangement is with the other party, that is other than employee, right? Suppose, for example, lawyer. Now lawyer has agreed to represent on behalf of the company in the court of law for any of their cases, and company and lawyer agreed that company will be discharging their lawyers fees by issuing the equity shares of the company, right? So that is the share based payment arrangement with the non-employee. Now, under that arrangement, there might be certain conditions that, lawyer will, once submit his visit fees invoice for all the appearances, say, because lawyer will be appearing, throughout the year on many dates on behalf of the company in the court of law. So there might be a payment arrangement as and when he appears, he can send the intimation to the company, and company will be issuing the equity shares for that particular appearance, right? So if suppose it is expected that he will be appearing for next 6 months on behalf of company every month, so there will be 6 visits. So for each visit, suppose company issues say 100 shares, then as soon as the lawyer confirms to the company that I have completed or discharged my obligation by visiting or completing the first appearance, so please, issue 100 shares. Then 100 shares will be issued. Then on the second appearance, once he confirms, again 100 shares will be issued. So in that fashion, whenever the other party discharges its obligation, that is of supplying goods or services in our example, then only they are entitled to claim the shares. So in that case, that date will become the measurement date or, grant date for the non-employees. So same is the example for, say, supplier of goods. Suppose company wants to purchase a machinery, then as soon as the supplier supplies the machinery, on that date, the fair value of the shares will be measured, and accordingly, how many shares needs to be issued will be decided and, discharged to the supplier, right? So we have just, to stick to the fact that goods and services are received or obtained by the company. So the date on which goods or services are being received or obtained will become the measurement date. And if these goods or services are to be received in installments over the period, then on each installment, there will be a measurement date, right? Okay. As of now, we briefly understood that there are certain conditions, terms and conditions to which both the party, the company and the other party, employee or non-employee, should have a shared understanding or an agreement, right? Now, those conditions may be of various types. So we will understand each type of the condition and their impact on the share-based payment arrangement, right? So once we are through with these conditions, we will completely understand what would be the share-based payment plan look like, right? So let's try to understand these conditions. Now, these conditions may be regarded in broadly in two categories. So one is the vesting condition and another is the non-vesting condition. So condition can be of two types broadly. One is called as vesting conditions. Others are called as non-vesting conditions. Okay. Now, vesting conditions means those conditions which will decide whether the shares will vest to the employees or non-employees or not. So vesting conditions are the deciding factor, right? Whether the shares will be issued to the other party or not. So vesting conditions, for example, in case of employees could be 3 years in service. Okay. So this may be regarded as service condition. Another could be revenue of the company grows by 10% each year. Okay. So this is the condition attached on the performance of the company that will be regarded as performance condition. Correct. Another could be that apart from employee being in service for 3 years, he or she should have been rated on annual appraisals for each year, at least, say, met expectations. Okay. So there might be three rating system for doing the appraisals for the employees, right? KPI, key performance indicators. So there might be a scale of 1 to 5. Okay. So 1 to 5 means 1 is low and 5 is highest, right? So employees should be at least lie here on a scale of 3 for each 3 years. So 3 means met expectations, 4 means exceeded expectations, and 5 means significantly exceeded expectations. Okay. So at least employee should have a 3 rated employee for each of the 3 years, and he or she should have completed the 3 years of service, and revenue of the organization should have grown by at least 10% in each year. Then if all these 3 conditions are satisfied, then only employees will get the shares. So this condition will be regarded as the service condition because there is as such nothing to do but not to resign, right? Second condition, revenue should grow by 10%. That is not at all in the hands of employee, right? So, but still there is a condition, so that has to be complied. Although employees are not supposed to do anything for this, right? They should only pray to the God on a daily basis that company should grow by at least 10% in their revenue each year, right? And the third is they should be conscious enough that they are performing, up to mark throughout the year and rated at 3 at minimum in each of the years, right? So if all these 3 conditions are satisfied, employee will be getting the shares after 3 years. So all these 3 conditions have an impact to decide whether the employees will be getting the shares or not. Hence, these will be regarded as vesting conditions, right? And in these 3 vesting conditions, this condition will be regarded as service condition and remaining two conditions will be regarded as performance conditions, because all are related to the performance. One is related to the performance of the organization and another is related to the performance of the employee, right? So those conditions are regarded as performance conditions. Now, what would be the non-vesting conditions then? Non-vesting conditions would be the conditions which have nothing to do with the decision whether the shares will vest to the employee or non-employee or not. So non-vesting conditions are just any additional conditions which nobody is, concerned about. So those conditions which do not have any impact on the plan, ESOP plan's success, those conditions will be regarded as non-vesting conditions. What is the definition? Vesting conditions: conditions that determine whether the entity receives the services that entitle the counterparty to receive cash or other assets or equity instruments of the entity under a share-based payment arrangement. So these conditions determine whether the counterparty or other party will be entitled or not to the shares of the company. So these conditions will be regarded as vesting conditions. Vesting period is the period during which all these vesting conditions are to be satisfied. Correct? Okay. Let's quickly understand all types of conditions in this chart. So conditions can be of two types: vesting conditions and non-vesting conditions, right? Vesting conditions means conditions which determine whether the entity entitled to receive services that entitle the counterparty, that is employees or other party, non-employees, to receive cash, other assets or instruments of the entity under the share-based payment arrangement. So these conditions which actually have an impact to decide whether the other party will receive the equity shares or not will be regarded as the vesting conditions. Now, vesting conditions can be of two types. Number one, service condition. Number two, performance condition. Service condition means it requires the counterparty, that is employees, say for example, to complete a specified period of service during which services are provided to the entity. For example, 3 years. Okay. If the counterparty, that is employees, regardless of the reason, ceases to provide services during the vesting period, it has failed to satisfy this condition. So he or she, whoever has resigned, will not be eligible to claim the shares of the company, right? It does not require a performance target to be met. So service condition can only be those conditions where are no performance targets given to the employees or to the organization, right? So service condition is a plain vanilla condition where employees or other parties are expected to be associated with the company for a minimum number of years or months or whatever, right? So that is all about the service condition. Just stay connected with the company and you are done. Service condition. Performance condition. It requires the counterparty to complete a specified period of service. For example, a service condition. The service requirement can be explicit or implicit, and specified performance targets to be met while the counterparty is rendering the services, right? Performance condition can either be a plain performance condition or a combination of service condition plus performance condition, right? So performance condition may say that employee should have been rated at least 3 for next 3 years. So it means service condition is implicit in the performance condition, because performance condition is minimum 3 rating for next 3 years. So for next 3 years will only be done when the employee actually continues with the organization for next 3 years. So service condition is implicitly covered within the performance condition, right? So performance condition can be a combination of service condition plus performance condition or a plain vanilla performance condition. For example, performance condition only can say, okay, if organization gets a 10% revenue growth each year, then shares will be granted under the plan. So this is the performance condition, and there is no service condition. Then if the entity grows revenue by 10% at the year end, shares are eligible to the counterparty, right? So performance condition can be a plain vanilla performance condition or can be a combination of service condition plus performance condition, right? What is non-vesting condition? Conditions not satisfying the service or performance conditions. So these are those conditions which are not meeting the definition of neither the service condition nor the performance condition. So those conditions are called as non-vesting conditions, and we shouldn't be worried about. All such conditions are to be ignored by the company as well as by the counterparty, right? Now, what are the types of performance conditions? Performance conditions may be related to the market related condition and may be non-market related condition. So market related condition, in it, the exercise price vesting or the exercisability of the equity instrument depends upon the market price of the equity instruments of the entity or the another entity of the same group. So if suppose, coming back to my previous example, where I have mentioned two types of performance conditions. Number one, revenue grows by 10%. Number two, employee has been 3 rated at least each year. Now, if I say there might be another type of performance condition, that share price of the company, grows from say 50 rupees, which is at present 200 rupees in next 3 years. Okay. Now this condition is a performance condition. Yes or no? Yes, this condition is a performance condition, no doubt about that, because it is saying that the share price of the company should grow from rupees 50 to 100 in next 3 years. And if it is met, that is share price reaches rupees 100, right, in next 3 years, for example, then only shares will vest to the employees. So there are 4 conditions. Condition number 1, employees are in the service for next 3 years. Condition number 2, revenue of the company grows by at least 10% each year. Condition number 3, employees should have been rated at least 3 on a scale of 1 to 5 for next 3 years. And condition number 4, share price of the company grows from rupees 50 to 100 in next 3 years. So these are the 4 conditions in the plan. Now, first condition, 3 years in service, is the service condition. Second condition, revenue growth at least 10% each year, is a performance condition. Third condition, met expectations for at least next 3 years by the employee, is a performance condition. Fourth condition, share price grows from rupees 50 to 100 in next 3 years, is a performance condition. Now, there is a small difference between this performance condition and these 2 performance conditions, right? This performance condition is dependent upon the share price of the company. And these 2 performance conditions are not dependent upon the share price of the company. Hence, the difference. So if the condition is dependent on the share price growth, okay, share price growth, okay, then this will be regarded as a market condition, because this is a market related condition, market price related condition. And if performance condition is not dependent on the share price of the company, for example, employee should be rated at least 3 for next 3 years, revenue should be grow by at least 10% for next 3 years. So this is a non-market related performance condition because this is not dependent on the share price of the company. So these conditions we will consider to decide whether the share options will vest or not. But share price dependent conditions we will ignore because employees can come and say that how illogical this condition is, right? Share price is not neither in the hands of the company nor in the hands of the employee, right? So it is a market perception about the share price of the company. So this is a pure play of demand and supply on the stock exchange, right? So that condition which is dependent on the share price we need to ignore in spite of the fact that meets the definition of a performance condition, but that will be out or will be ignored for the purposes of making the decision whether the share options will be vested to the employee or non-employee or not, right? So we need to ignore two types of conditions. Number one, non-vesting conditions. Number two, share price dependent performance conditions, which is regarded as market related condition by the standard. So standard says if there are any conditions dependent on the performance of the share price, then those conditions are called market related conditions, and those conditions we don't need to consider for deciding the vesting of the options, right? So a non-vesting conditions anyway are not affecting the vesting. So non-vesting conditions and market related conditions, both these needs to be ignored, and service condition and performance condition which are non-market related condition, that is dependent on the other factors other than the share price performance parameters, that will be considered for the purpose of deciding whether the vesting is happening or not. Is the concept clear? Any queries, questions on any of the conditions definition? Okay. Now, what are the examples of market conditions and non-market conditions? Market conditions is a performance condition linked to the market price of the equity instruments, right? For example, share price must increase by 15%. Total shareholders return must increase by 10%. So shareholders return will increase by 10% only if the share price increases by 10%, right? So again, that is indirectly linked to the share price only. So these are the market conditions and hence needs to be ignored, right? And non-market condition is the performance condition that is not linked to the market price or of the equity instrument. These vesting conditions are taken into account by adjusting the number of equity instruments included in the measurement of the transaction amount so as to reflect the number of awards are expected to vest, right? So these conditions will affect how many shares will actually vest to the employee or other party. For example, revenue must increase by 10% or market share should increase by 5%. This market share is not shares or securities. This market share is the share of the company in the market. For example, company, covers 30% market share of India and 20% market share in the export market. So that market share we are talking about, right? So if we say that at present company has say 10% market share, and if company achieves an increase by 5%, that is 15% market share, then this will be regarded as a performance condition and not related to the share price. Hence, this will be considered for deciding whether the vesting will happen or not, right? So if company achieves market share of 15% in next 3 years, then this condition is deemed to be met, right? What happens if the conditions are not satisfied? So if vesting conditions are not satisfied, no amount is recognized. right? So no expense recognition. Okay. And if market conditions are not satisfied, then irrespective of whether the market conditions are satisfied or not, recognition of goods and services shall be done. That is, recognition will continue to happen. Right? So, vesting conditions are important. If vesting conditions are not met or not satisfied, then recognition is not allowed by the standard. But if non-vesting conditions, oblique market conditions, non-vesting conditions, oblique market conditions. Market conditions means conditions related to the share price. Right? If these conditions are not satisfied, then recognition will continue to happen. Right? It will not affect the recognition. Let's do quick some examples. Employee will get 100 shares each if they remain in employment for next 3 years. Which condition is this? Service condition only, right? Just stick to the company and get the shares. Employees will get 100 shares each if company's share price reaches INR 1000 per share on NSE, National Stock Exchange, in next 2 years. Which condition is this? Market condition. It does not have any impact on the vesting, right? No impact on vesting. Employees will get 100 shares each if they remain in employment for next 2 years and company's EBITDA rise to rupees 10 crore. Say, for example, at present company's EBITDA is 5 crore and company says, okay, if our EBITDA rises to 10 crore in next 2 years and you are continuing with the company for next 2 years, then only you will get the 100 shares each. So this is an example of service condition, that is employment for next 2 years to be continued, plus non-market performance condition, because increase in EBITDA is not related to the share price, right? So increase in EBITDA is a non-market performance condition. Company announces 100 shares each to employee as gift on 10th anniversary of the company. So there are no vesting conditions attached to it, because on the annual day function, company announces that we will give 100 shares to each of you because today is our 10th anniversary. So whoever employees are with the organization on that date, they don't need to serve any more period or any further service period, and they are getting these shares on the very same day, right? So there are no vesting conditions, no vesting period. As soon as the company announces this benefit or gift to the employees, they are immediately recognized in the P&L, right? Because employees can ask for these shares on the very same day when the announcement is made, right? So no vesting period, no vesting conditions. Company gives 1000 shares to a director for non-competing with the company for next 3 years. So again, here it is no vesting conditions. Why? Because 1000 shares are given to the director for non-competing with the company for next 3 years, right? So for next 3 years, it is not expected that director needs to serve with the company, right? It is a just matter of fact, he shouldn't, start a business in which the company is operating in next 3 years. So there is no service condition because director is not expected to continue employment with the company. What he is expected only not to compete after he has left the company, right? So after he has left the company, he is not expected to compete for next 3 years. So there are no service conditions, no performance conditions. hence no vesting condition. So these 1,000 shares will immediately vest to the director, and director can ask for these 1,000 shares immediately, as and when he agrees that he will not compete with the company for next 3 years, right? Any doubts on any type of conditions you want me to discuss again? Can you please ping in the chat box if it is clear? I know it is 8:35 now and we should have a break, but I have one more slide talking about the decision tree, how these conditions needs to be assessed and satisfied. Thereafter, we will take a break of 10 minutes and we will discuss the next concept, right? Non-compete agreement is a kind of agreement. Yes, that is a separate agreement, right? So there are two things. One is the share-based payment arrangement, and another is the obligation what the other party has to perform. So other party has to perform is a separate agreement, that he is not expected to compete with the company after he left the company for next 3 years. So that is the another agreement which he has signed or entered into with the organization. Once he has signed that agreement, company is giving 1,000 shares to him as a reward or compensation, right? So those 1,000 shares immediately vest to the director and immediately recognize as expense in the books of the company, because there is no service condition, no vesting condition, right? Okay. Now, what is the decision tree for satisfying all such conditions? So if we start from here, what we will check first? First, we will see what are the conditions in the share-based payment arrangement which determines if the entity receives services against share-based payment. So if there are any such conditions, then condition requires only a specified period of service to be completed. For example, you should be completing 3 years with the company and you will be getting the awards. If this is the only condition, if the answer to this is yes, then it is a service condition only, right? And if the answer is no, there are other conditions too, then we will see, is there any target based on the share price of the entity or the group entity? If the answer is yes, then it will be regarded as market condition, ignore. And if this is not related to the share price, but to other performance parameters, for example, revenue growth 10%, EBITDA growth 10%, market share expansion by 5%, or employee, performance is, average and above. So these are called non-share price linked performance conditions, hence non-market conditions. These needs to be considered. Okay. Now, let's quickly understand the impact of all these conditions, multiple conditions. Scenario 1, service condition met. Employee has served the 3 years which was required. Market condition, share price growth by 10% is, achieved. Non-market performance condition, revenue growth by 15% achieved. Then recognition under Ind AS 2, Ind AS 102 will happen or not? Yes, it will happen. Service condition 3 years met. Share price growth condition, that is market condition, not met. Okay. So this is not met. And non-market performance condition, for example, revenue growth by 10%, this condition is met. Now, recognition under Ind AS 102 happens or not? Yes, it will happen, because we will ignore market condition. We are not supposed to take into account market conditions, right? So if even if this is met or not met, it doesn't have impact on the recognition under Ind AS 102. Only this condition needs to be met and this condition needs to be met, right? Third scenario, service condition met, market condition met, non-market condition not met. Okay. Then recognition will not happen because service condition, although complied with, and non-market performance condition is not complied. And unless and until this is complied in conjunction with the service condition, recognition is not allowed. So recognition will not happen in this case. Now, service condition met, non-market condition not met, or sorry, market condition not met, non-market condition also not met. So no recognition. And this recognition is prohibited for same reason, because this condition is again, unsatisfied. Now, service condition not met. So anyway, if service condition is not met in any of the scenario, right, then definitely recognition will not happen. Right? Understood? So key concept is service condition is mandatory to be satisfied. Non-market performance condition is also mandatory to be satisfied. If either of these two conditions are unsatisfied, recognition will not happen. Clear? I hope by now you must have understood the demarcation between the market condition and non-market performance conditions, right? So performance condition can be of two types: market condition, non-market condition. Market condition dependent on the performance of the share price, non-market condition which is not dependent on the performance of the share price but any other parameters other than the share price performance. So those needs to be considered, and share price linked performance conditions are to be avoided or ignored for the purposes of Ind AS 102 vesting decision. Correct? Yes. So PPT will definitely be uploaded on the portal after the session. You will get it today itself. Okay. So there is two small, key terms, and then we will take a quick break of 10 minutes. So there is a reload feature and there is a reload option. Okay. Reload feature, a feature that provides for an automatic grant of additional share options when the option holder exercises previously granted options using entity shares rather than cash to satisfy the exercise price. Okay. What does this mean? Reload feature means, suppose employees are in the service with the company and they have completed the service condition and performance conditions. They are entitled to receive the shares of the company, and they have received exercise for those shares and received the shares in their demat account. Right? Now there is another plan announced by the company. Okay. In that plan, if there is any exercise price which needs to be paid by the employee, for example, fair value of the share is 50 rupees and exercise price kept by the company is 10 rupees. So 40 rupees is the benefit to the employee. Now that 10 rupees either can be paid by the employee in cash on the exercise date, or it can ask the company that instead of me paying cash of rupees 10 to you, you can deduct the 10 rupees equivalent number of shares from my exercise and, credit the remaining shares to me. Okay. So exercise price, instead of being paid by the employee in cash, is adjusted against the previously exercised or granted options or shares, so that employee doesn't need to pay anything to the company and he will get the shares. Right? So that is the reload feature. If reload feature is there in the share based payment plan. So what happens whenever the employee says that okay, I will pay you the exercise price by the granted options rather than cash. Then what happens? A new share option is granted when such exercise price obligation is discharged by the employee by using the previous share option. So new options are uh, you know uh, become eligible to be granted to the employee. So those are called reload options. So as soon as the employee uses the previous shares for discharging the exercise price obligation, he gets the new options, right? So the treatment of the reload feature will be same as the new ESOP plan, right? So new option. So it shall be accounted for as the new option grant if and when the reload option is subsequently granted. So these are the new shares which will be issued to the employee subject to the new terms and condition of the vesting period. So this will be regarded as the new option grant, right? Because he has exercised his previous grant against the discharge of exercise price, which otherwise would have been paid by the employee to the company in cash. So simple as that. That either I can discharge the obligation in cash of the exercise price, or I can discharge the obligation by giving back the shares to the company. So if I give back the shares to the company for discharging the exercise price obligation, then new shares gets activated, and those shares will be accounted for as the new option grant only. So that is nowhere different from the uh, new ESOP announced by the company, right? So these are the key terms, and now we can have a break of 10 minutes. We will, resume at 8:56, right? And then we will understand what are the types of share-based payment transactions and the accounting of those types. Okay. So see you back at 8:46. Oh, 8:56. Sorry. Okay. Thank you for the confirmation. So now we have understood the scope of the standard key terms: grant date, exercise period, exercise date, vesting conditions, vesting period, non-vesting conditions, then market related conditions, non-market related conditions. So all those key terms, key definitions, and the concepts we have discussed and understood. Now the time is to understand what are the types of share-based payment transactions, right? So broadly, there are three types of share-based payment transactions. Number one is equity settled share-based payment transactions. So equity settled share-based payment transactions are those share-based payment transactions where the transaction is settled or obligation is discharged by the company by issuing the equity shares of its own company or equity shares of any of the group company, maybe a parent company or subsidiary company, right? So whenever equity shares are issued to discharge the obligation, those are regarded as equity settled share based payment transactions, right? So in this, entity receives goods or services as consideration for its own equity instruments, including share or share options, or receives goods or services but has no obligation to settle the transaction with the supplier. So somebody else might be settling this transaction on behalf of the company. Who that somebody else might be? Either it can be a holding company, that is parent company, or it can be another subsidiary company within the same group or another shareholder of the company, right? Okay. So when company discharges the obligation in its own equity shares, it is called as equity settled transaction. Or if there is no obligation on the company to discharge, but that has to be discharged either by parent or subsidiary or other shareholder, then also it is regarded as equity settled transaction. Number two, cash settled transactions. Cash settled share based payment transactions. Now, as the name suggests, it means here we are not, settling the obligation by issuing equity shares. Rather, we are settling the obligation by paying cash or other assets in lieu of cash other than the equity shares, right? So we are not giving shares, but we are giving something else. That something else might be a cash or some other assets, for example, gold, silver, jewelry, or whatever, right? Any other financial, non-financial assets, machinery, plant and machinery, raw material, inventory. So whatever other assets we are, giving other than equity shares will be regarded as the cash settled share based payment transactions. In it, entity acquires goods or services by incurring a liability to transfer cash or other assets to the supplier of the goods or services for amounts that are based on the price or value of equity instruments, including the share or share options of the entity or another group entity, right? Now, one piece is clear that equity shares are not being issued in this case. The another important aspect is whatever cash or other assets we are giving up to the other party to discharge the obligation will be determined based on the share price of entity or group entity, right? So how much cash or how much other assets or a combination of cash or other assets of what value will actually be given to the other party, counterparty, will be determined basis on the share price of the entity or the group entity, right? So those are regarded as cash settled because equity shares are not issued in this case. But how much cash will be given will be determined basis on the price of the equity shares of the entity or another group entity within the same group, right? Third category is share-based payment transactions with cash alternative. So where I am saying to the counterparty that either I will give you the shares or I will give you the cash. Okay. So share-based payment transaction with cash alternative. So I can give shares, I can give cash, or you can demand shares or you can demand cash. So both the options are available, either shares or cash, or even a combination of shares and cash, right? So in that case, this is the third category of share-based payment, that is called hybrid, or share-based payment transactions with cash alternative. So three types. One is settled by equity, two is settled by cash, three is settled by either equity or cash or a combination of equity or cash, right? So these are the three categories, and the accounting is also different for all these three. Hence, the categories, needs to be understood clearly. Any questions? Okay. Now, what will be debited and what will be credited? How the journal entry will look like whenever we are supposed to record the share-based payment transactions in our books of account, right? So now that is the question. So we will debit either the asset or the expense, right? So if we are issuing shares or if we are, delivering cash determined basis on the share price to the employees, then we will say employee benefit expense. Employee benefit expense debit, right? This account will be debited. If we are issuing shares to the supplier of the goods, for example, some supplier is supplying me with the raw material supplier, then I will debit what? I will debit inventory account debit. If I have purchased a machinery from some supplier, then what account I will debit? Machinery account I will debit. Right? If I have purchased land or building, then correspondingly land or building account will be debited. So whatever, services or goods I am, receiving, those, accounts will be used for the debit. If I am receiving the services of the lawyer, then which account will be debited? Professional service account debit. Professional service expense account debit, right? If I am receiving any marketing, services from any marketing agency, then advertisement and marketing expense account debit, right? Correct. So we need to debit those accounts for which we are receiving the goods or services, right? So this is the debit side of the entry. What would be the credit side? Now, credit side either will be a equity or will be a liability, right? So on the credit side, if goods or services received in the arrangement are settled by issuing equity shares, that is equity settled, then equity will be credited. So debit all these accounts and to equity account, right? Of course, equity will be debited by face value. Then remaining amount will be credited by security premium account. Security premium, right? Balancing figure basically. Yes or no? Yes. If these are to be treated as liability because they are to be settled by payment of cash, then I will record the liability. So how the liability will be recorded? To the vendor account, right? Whoever is the vendor. Or in case of third part, counterparty is employee, then to employee payable account. right? Payable account. So this is how the debit and credit will look like. So debit will be either the expense if it is pertaining to the expense, or the asset, for example, inventory, machinery, building, land, right? If it is pertaining to the asset, so that account will be, debited. And credit, if it is settled by issuing equity shares, then credit to equity. If it is settled by payment of cash, then it will be credited to the liability initially, right? And thereafter liability will be discharged by payment of cash. So the another entry will be vendor account debit, or employee payable account debit to cash or to bank, whatever it is, right? This is how the settlement takes place. Any doubts on the accounting, debit credit in both the scenarios? If it is clear, just mention in the chat box so that I can understand that whatever we are discussing, you are, understanding and we are on the same page before I proceed. So Munish has asked one question before we went on the break. I will pick up your question because that is related to the previous, topic at the end of the session. Okay, Munish? Just to, avoid disgracing the flow now. Okay. So now we have just discussed that there are three types of share-based payment transactions. One is equity settled, another is cash settled, and third is hybrid. That is share-based payment transaction with cash alternative. So either it can be equity settled, or it can be cash settled, or it can be a combination of equity and cash, right? So that is hybrid. So equity, cash, hybrid. Three are the broad categories or main categories, right? Now, first we will discuss equity settled share-based payment transactions. What does equity settled share-based payment transaction means, how they look like, and how they will be accounted for? So equity settled share-based payment transactions are measured based on with whom the transaction has been done. With whom means either it can be with the employee or it can be with the non-employee, right? So there can be two parties. Either the other party is my employee, or the other party is my, non-employee, or the third party, right? So if the transaction is with employee, then what is the measurement principle? Measurement principle says that you need to calculate the fair value of the equity instruments you will be granting to the employees, right? So fair value needs to be determined of the equity shares which will be, granted to employees. And if it is related to non-employee, then fair value of the goods or services received, if can be estimated reliably, needs to be determined. So in case of employees, ideally, we determine the fair value of shares, right, on grant date, right? And if the other party, counterparty, is not the employee of the company, it is a third party like supplier of the raw material, supplier of the machinery, or, service provider, then fair value of goods received oblique services obtained needs to be determined if that can be measured reliably, right? So if the goods are being supplied of rupees 5 lakh, then I will certainly be discharging the obligation by issuing the number of shares having a fair value of 5 lakh, right? So my number of shares, how many number of shares will be issued, is dependent on what is the value of the goods or services I am receiving, right? So if 5 lakh worth goods are supplied by the supplier, then to discharge 5 lakh, I need to issue that number of equity shares which multiply by their fair value will be equivalent to the 5 lakh, right? If this fair value of the goods and services cannot be determined, right? Rebuttable presumption. Then we will determine the fair value of the shares that we are agreeing to issue to the supplier, right? Fair value of shares. But that would be very rare because, goods and services always come with a price tag. So we know what is the worth of the goods and services. So this cannot be said that we cannot, estimate the value of the goods or services which we are receiving from the supplier, right? Now, this is the measurement principle. What is the measurement date in this case? Measurement date would be the grant date, the date on which the company has announced the employee stock option plan and has communicated the terms and conditions of that plan to all of its employees after taking necessary approvals from the board of directors or the shareholders, as the case may be, which we had discussed at the initial stage of this standard, right? So grant date would be the date on which ESOP plan gets started. That is, from today, the 3-year service period gets started. From today, your performance conditions gets started, right? So that is the start date, called as grant date, on which the fair value of the equity shares needs to be measured. Now, that is in case of employees. Now, in case of non-employee, what needs to be done? Fair value on the date on which the entity obtains the goods or services or the counterparty renders the services, that date will be regarded as the measurement date, right? So if the counterparty supplied goods on, say, 21st of October, then 21st of October would be the measurement date on which the fair value of those goods which are supplied or those services which are rendered by the service provider to the organization will be measured. And if we say that we are unable to measure the fair value of these goods or services reliably, then there is a rebuttable presumption, and we will exercise that rebuttable presumption and will measure the fair value of the equity shares, rather, which we will be issuing to the supplier of the goods or service provider in that case, right? Now, recognition date, on which date we will pass the journal entry in the books of accounts, the date on which the goods or services have been received. Now, in the case of employee, what do you think? On which date the goods and services are received? In the case of employee, employee renders the service on a daily basis, right? So recognition, should happen on a daily basis of the expense proportionately spread over the 3 years, because 3 years is the service period condition. So expense will be spread over the 3 years period. Now, employees, serving the company on a daily basis. So should I record the expense divided by 3 years into a number of days? So 1 day per day calculation. So for the comfort, we can, book the expense on a monthly basis, because generally companies, prepare the P&L and, balance sheet, for internal monitoring and reporting purposes to the management of the company. So they generally, freezes their trial balance on a monthly basis. So on a monthly basis, this expense will be recorded in the books of the account, right? Or company can do so on quarterly basis as well, right? Because if they are listed companies, they have to report the results to the exchange on a quarterly basis. So quarterly basis, anyway, company will be, required to pass the entry. So, but ideally, the expense is spread over the service period and recorded accordingly, right? And what is the recognition date in case of parties other than employee? The recognition date would be the date on which the goods and services are received. So the day on which the goods are received, I will recognize the expense. Suppose if I have received the inventory or raw material which I have ordered. So once I book that inventory, I will automatically book the expense, and automatically, if it is a equity settled, I will credit the equity leg in the entry. If it is a cash settled, I will settle it through cash by creating the liability first, and then that liability will be discharged, right, as per the terms. So I hope we have understood the definition of equity settled share based payment plans and the accounting in both the scenarios, when these are with the employees and when these transactions are with non-employees, right? Any questions on this? No questions? Okay. Now, in equity settled transactions in which services are received and equity instruments are granted, right? Those are called equity settled. So now there can be two scenarios. If these shares vest immediately because there are no service conditions. For example, I have given an example that company announced 100 equity shares to each of its employees on the 10th anniversary celebration in the company, right? So as soon as the company announces and there are no further conditions, so this 100 shares to all those employees immediately vest, right? Vest immediately. And if the employees are supposed to serve the organization for say next 1 year, 2 years, or 3 years, 5 years, 7 years, 10 years, then in that case, these awards or share options will vest over that period. So they do not vest immediately, right? Do not vest immediately. Now, if they vest immediately, the counterparty is not required to complete a specified period of service for entitlement, correct? In other words, it is presumed that services are rendered by the counterparty as consideration for the equity instruments have been received. On the grant date itself, the entity will record the expense in its full amount. That is 100 shares. And suppose if there are 100 shares to each employee, into May, 50 rupees is the fair value on the grant date of each share. Into May, if there are suppose 120 employees, or say for the sake of simplicity, say 1,000 employees, okay, then 100 into May 50 into May 1,000, whatever the amount comes, this 50 lakh. So this 50 lakh will immediately hit to the P&L when this vests immediately, right? And if this do not vest immediately, then this 50 lakh will be recognized over the vesting period, right? And that we will see through practical questions how this is recognized over vesting period. So now a lot of theory we have discussed since morning. It's time to gear up and do some practicals, because ultimately practicals will be helping us to understand the concept better. So Borealis Limited offers 400 shares to each of its 1,000 employees if they stay with them for next 3 years, and fair value of the shares on that date means grant date, was rupees 50. So 50 rupees is the fair value given in the question on the grant date when the plan is announced by the company. 1,000 is the number of employees to whom the plan had been announced by the company on the grant date because there were 1,000 employees with the company on that date. And if they remain with the company for 3 years, next 3 years from this announcement date, 400 shares will be given to them as a award after completion of 3 years, right? So this is the fact. At the end of year 1, 20 employees leave and the entity estimates that total of 25% of the employees will leave by the end of the 3rd year. Vesting period is ending 3rd year, right? So 20 employees have already left the organization in year 1, and the company estimates that by the time we reach to the vesting date, 25% of the employees, that is 1,000 employees into my 25%, how much? 250 employees. 250 employees will not be there in the organization to claim the entitlement. That's what it means. During the 2nd year, a further 20 employees leave and the entity further revises its estimates of the total departures by the vesting period comes to an end from 25% to 28%. So earlier the estimate was 250 employees. Now the estimate is 280 employees will leave the organization. During the 3rd year, further 20 employees leave the entity. So how many employees all in all left? 60 employees. Company was estimating 250 employees or 280 employees. But actually, the total actual departure is 60 employees. Determine the amounts to be recognized in the income statement. So this is the first question. So I will be solving it. Next question you will be solving. Okay. Fair value on the grant date. How much? 400 is the number of shares. 1,000 is the number of employees. And 50 is the fair value. So total amount comes to how much? Crores. Right? This is the total amount or fair value amount on the grant date. Right? Now, year 1, company says 75% of the employees will only be there in the organization by the end of the 3rd year. So, this much into my 75% into my 1/3, that comes to 50 lakh. So 50 lakh would be the expense for the 1st year. How it is calculated? Total fair value into my 75%, because ultimately this value, fair value amount is for all 1,000 employees. But company says only 750 employees will be there to claim. So only for 750 employees, how much value it would be? So 2 crores into my 75%. And because this 2 crores expense fair value is expected to incur over 3 years, so we will divide by 1/3. So because we are claiming the expense for 1st year, so this comes to 50 lakhs. Now, at the end of the 2nd year, fair value is still same. Now company says only 72% of the employees will be there in the organization, and 2/3 expense we need to recognize by the end of the 2nd year. So into my 2/3, so 96 lakhs. So 96 lakhs is the cumulative expense, right, for year 2. So for year 2, how much debit will go to the P&L? 96 lakhs minus 50 lakhs, 56 lakhs. That is 46 lakhs, right? This will be the expense recognized in the P&L. Now in the 3rd year, when actually only 60 employees left, so 940 employees will be there. Into my 50 rupees is the grant date fair value. Into my 400 is the number of shares which will be granted to each of these 940 employees. So this comes to 1 crore and 88 lakhs. as the total expense, cumulative expense for the year 3. Now from this, how much we have already recognized? 96 lakhs we have already recognized by now. So the balancing figure would be 92 lakhs, which will be recognized as expense in the year 3. Clear? So what would be the entry? Entry would be employee benefit expense account debit year 1 to equity based share awards. Okay, this is a nomenclature. You can choose according to your wish. So whatever nomenclature you want to use. So this would be one of the equity account for the tracking purposes. So equity based share based payment awards account. So year 1 50 lakhs, year 2 46 lakhs, and year 3 92 lakhs. So this entry will repeat on year 2 and year 3 as well by the same amount, right? And during the third year, whenever we are actually issuing these shares, right? So we will debit this account, equity based share based awards, to equity, basically share capital, and to security premium, right? So this would be the entry passed on in year 3 whenever the equity shares are issued. So this is the notional account for the time being, which will get settled when the equity shares are issued, right? So this is how the expense needs to be calculated and, booked in the books of accounts. So the key point to remember is always calculate the expense on cumulative basis and deduct the expense already recognized in the previous years, so that to find out how much expense needs to be recognized in current year, right? Don't do any calculation otherwise you will be mistaken in the calculations. Always do the calculations basis on cumulative charge and then deduct the previous year recognition amount to arrive at the expense amount needs to be recognized in the current year. Okay. Now, this is the question which you will be picking up and coming up with the answer in the chat box. Omega grants 120 share options to each of its 460 employees. So, how many employees? 460. How many options? 120. Each grant is conditional on the employee working for Omega over next 3 years. Okay. So, again, 3 years is the condition. Omega has estimated that fair value of each share option is INR 12. So, number of employees we have in the question, how many number of shares options will be granted? We have what is the service period? We have 3 years vesting period and the fair value on the granted date. We have these are the 4 parameters or 4 information points we need. Omega estimates 25% of the employees will leave during the 3-year period, so forfeit their rights to the share options. Everything turns out exactly as expected. Calculate the amounts to be recognized for services received as consideration for the share options during the vesting period. So, can you please tell me the year 1 expense, year 2 expense, and year 3 expense amounts? Quickly. Now, I'm waiting for 60 seconds for you to ping me in the chat box with the answers. 165 600 in each year is messaged by Anish. Okay. Mr. Mohammed has the same answer. Year 1, 2, 3 will be same. That is 1,65,600. Okay. Should I assume unanimously everybody is reaching to the same answer? Okay. Let's see. So in this question, entity estimated that 75% of the employees will be continuing. That is 25% will leave the organization. And facts of the question says everything turns out as expected. So there is no change, right, in year 1, 2, and 3. So this 75% employees is constant. Fair value is anyway always constant, right? Granted fair value only we should consider. So number of options, because number of employees is constant, so number of options is also constant. So year 1 by 3, 2 by 3, and 3 by 3. So, the expense amount is same for each of the years. So answer given by both of you is correct. Okay. So this is how the equity settled transactions, needs to be accounted for, and how the calculations are performed. We have just understood through these examples. Now the another type is cash settled share based payment. In this case, what will happen? We will settle the transactions instead of by issuing the equity shares, but we will pay the cash only, equivalent to the value of equity shares. So cash will be paid equivalent to the value of equity shares. On the date of settlement. That is after the vesting period is over, right? So this is how the cash settled transactions would be. Let's understand first the initial measurement, remeasurement, how they will be accounted for. So measurement and recognition. Initial on day one, when the plan is announced. So now company is saying to its employees that we will be giving you the cash after the end of 3-year service period condition if you met, or other performance conditions if there are any are met, a cash equivalent to the fair value of the shares, right? So the entity shall measure the goods or services received, acquired, and a liability incurred at the fair value of the liability. So what is the fair value of the liability? So fair value of the liability is the fair value of the goods and services in case the party is other than employee, or the fair value of the liability is the fair value of equity shares in case the other party is employee, right? Now, at each date until the settlement happens, this cash settled transactions liability will be remeasured. So until the liability is settled, the entity shall remeasure the fair value of the liability at the end of each reporting period and at the date of settlement, and recognize all changes in the fair value during the vesting period or this period in the P&L account, right? OCI not allowed. Okay. So P&L account only. We will recognize this change in fair value in P&L for that period, right? These share-based payment transactions results in a liability as they represent an obligation to pay cash. Because whenever we have an obligation to settle anything in cash or in other assets other than equity shares, then that is regarded as a liability, right? So we will have a liability to pay cash on the settlement date. Same as equity settled share based payments, expenditure to be spread over the vesting period, right? So expenditure will be spread over the 3-year service period in same manner like we have just done in case of equity settled transactions, and all the expense will be recognized immediately if there is no vesting period, right? So same for the equity settled as well. Treatment of the vesting conditions is same. So all these three things are same as what we have been doing for equity settled, with one change, that is the remeasurement. So equity settled options are never remeasured. Okay. So cash settled transactions always remeasured at fair value at each reporting date. Each reporting date until settled, right? And equity settled are never remeasured. So that is the key difference between the accounting for equity settled and cash settled. So equity settled are measured only once in the life, that is at the grant date, and that grant date fair value will be amortized over the service period, that is the 3-year period in each year for the expense recognition. In cash settled, we amortize the expense in each year the way we have been doing for equity settled, but we have to remeasure the liability for cash settled options at each reporting date as well, right? Let's do the practical. Vesting conditions क्या है? 3-year continued employment, that is service condition. Market based performance condition assumed to be satisfied. Assumptions: 100 share are granted on 1st of January. Best estimate is that all employees remain in the service over the vesting period. So no employees are leaving the organization. This is the estimate by the management. Okay. Grant date fair value of each right is ₹3, right? Subsequent estimates: at the end of year 1, fair value is 4. At the end of year 2, fair value is 4.25. At the end of year 3, fair value is 4.5. And on the settlement date, fair value is 4. And intrinsic values are also given on these dates, which is as below. Now, what you are supposed to do is to calculate the expense for each year and the settlement amount finally being settled on the settlement date. So that is the ask. Okay. Let's quickly see and understand the calculation. Assume that all the service conditions are fulfilled and that the vested benefits are settled at the end of the year 4, right? So 3-year is the service period and 4th year we are making the settlement, right? So for the year 1, how much expense will be recognized? 133. How it is calculated? So it is calculated 100 shares, right? Into में fair value on the grant date ₹3. Okay. So is equal to 300 divided by, best estimate, all the employees are in service. Grant date fair value is 3. Okay. So year end pay value is 4. So into में 4 we will multiply because we need to remeasure as well. So 400, right? 400 divide by 3 or into में 1 by 3 basically, right? Because we are calculating the expense for the year one. So this will come as 133. Then in the next year, what would be 100 into में 4.25. So 425 into में 2 by 3, right? So this will come to how much? 283, right? So this will come 283. Now from this 283, we will deduct year one recognition 133. So 0, 5, 1. 150 would be the expense for the year two, right? So this is how 100 into में 4 into में 1 by 3. This is 100 into में 4.25 into में 2 by 3 minus this amount, right? And third date fair value is 4.5. So again, in this case, what we will do? 100 into में 5 into में 3 by 3 and minus में this plus this. So both these, which we have already recognized in year 1 and 2, will be deducted, right? So 450 is the value minus 283. So how much is the amount? 167 we will be recognizing. Now on the settlement date, fair value is 4. So by how much we will be settling? 100 into में 4, right? 100 into में 4. But how much expense we have already accrued in the books till now? 450. So 50 will be a reversal or settlement gain will be credited to the P&L, right? Any questions on this? Concept is clear? Now, in this case, what would be the entry? Because like we have discussed the journal entry for, this one. So similarly, we need to understand what would be the entries for this cash settled as well. So in this case, entry would be employee benefit expense account debit to cash settled share based payment awards account. Okay, 133 ईयर वन में, सेकंड ईयर में सेम एंट्री 150 150, थर्ड ईयर में सेम एंट्री 167 167. ओके, एंड फोर्थ ईयर में कैश सेटल्ड शेयर बेस्ड पेमेंट अकाउंट डेबिट बाय हाउ मच? 450 टू P&L, that is settlement gain 50 to cash 400. So 400 is the final cash which we will be discharging. 50 is the settlement gain to be recognized on the settlement date, and this notional account credited in 3 years will be debited and nullified, right? So this is how the accounting will happen for the cash settled. I hope this accounting is clear for the cash settled transaction. Please confirm in the chat box if it is so. So Munish is asking, but initial estimate to be done on vesting date, fair value. Correct. So on the day the plan is announced, the fair value is how much? 3 rupees. So definitely 300 into में 1 by 3, that is 100, will be recognized over the 12 months, right? And as soon as we reach on the 12th month end date, that is the reporting date, the fair value is 4. So this adjustment of rupees 33 will be reflected in the 12th month if you are recognizing the expense month on month basis. Correct, Munish? So for the sake of simplicity only, I have started with the 4. Now, as the rule, first question I do, second question you need to give the answer. So this is the question from your study material of the institute. Now you will be instead of passing the journal entry we can discuss, but you just tell me the expense amount for year 1, year 2 and year 3, right? So that amounts you need to punch in the chat box. So let me read the question for all of you. XYZ Limited issued 10,000 share appreciation rights. Okay. So 10,000 is the number of shares that vest immediately to its employees on 1st of April 2010. Okay. The SARs will be settled in cash using an option pricing model. At the date, it is estimated that the fair value of the SAR is 95. Okay. So 95 is the fair value, right? SAR can be exercised anytime up to 31st March 2013. At the end of the period on 31st March 2001 or 11, I would say, it is expected that 95% of the employees will exercise the option. 92% of the employees will exercise the option at the end of next year, and finally 89. So in year 1, estimate was 95%. Year 2, it is 92%. And year 3, it is 89% that the employees will be there, right, to exercise. Fair values at the end of each period have been given below. Year 1, year 2, year 3. Fair values are given. Now you just need to calculate the expense for, this share-based payment option plan for the 3 years. So I'm waiting for your responses in the chat box. And in luck, somebody might have arrived with the answer. On grant date, 9,50,000. Year 1, 1,14,000. Year 2, 61,200. Year 3, 11,800. Okay. Manisha has pinged first. So let's see how the calculations are done. So on the grant date, fair value is 95, year 1, year 2, and year 3, right? These are the fair values given in the question. Awards to be vested are 100%, 95%, 92%, and 89%. So calculation will be 9,50,000 for the grant date, and thereafter it will be revised basis on the estimated number of employees as well as the change in fair value, right? So these are the amounts by multiplying A into my B into my 10,000, because 10,000 is the number of options that is anyway fixed, right? Now, how much expense would be? So on the grant date, the expense would be 9,15,000, right? For the year 1, it would be 1,14,000. For the year 2, it will be 61,200 negative, correct? And for the year 3, it will be 11,800. Very apt, Manisha. Okay. Anish has answered, but answer seems to be a little different. Same for Mohammed. So this is the correct answer. Manisha, your answer is correct. On 1st of April 2010, employee benefit expense account will be debited and share-based payment liability account will be credited. That is the fair value of the share-based appreciation rights, right? And then 31st March 2011, employee benefit expense account will be debited and share-based payment liability account will be credited by this much amount, right? Then year end 32, share-based payment liability account will be now debited and employee benefit expense account will be credited because now the value has come down, fair value. So expense already over recognized needs to be, reversed. So this is the reversal entry for the expense because fair value has come down in year 2, right? So 61,200 is the amount by which the expense will be reversed or the liability will be reversed, right? Then in year 3, again, the fair value goes up and hence the expense will be recognized. And finally, the share-based payment liability will be settled at 10,14,600 rupees, right? I hope the answer is clear to everyone. Correct? Okay. So now the third type of the share-based payment award, finally, we have reached to. So we will, end the session after discussing this third type. And then in the next session, we will talk about the remaining concepts, modification, cancellation, settlements, purchase, and other matters, right? So this is the third category, which we need to understand. Share-based payment transactions with cash alternatives, right? So here is the cash alternatives available. Now, in this case, what happens? There could be two scenarios. Number one, share-based payment transactions provide the counterparty, that is the other party, with a choice of settlement. That is, other party can ask either for shares or for cash. So other party has the right to ask either for shares or for cash. Hence, it will be treated as a compound financial instrument compo, right? So it will have a debt component, that is liability component. It will also have a equity component, right? So there will be debt component, there will be equity component. Both the components will be there when the counterparty has the right to ask, because organization doesn't know what the counterparty will finally ask at the end of the 3-year period, right? They may ask shares, they may ask cash, they may ask a combination, right? So I have a liability. And since there would be certain portion of equity component as well, so it is a compound financial instrument in which debt component and equity component both will be there, okay? If the entity has the choice of settlement, so here entity has the say whether the entity wants to settle it through issue of equity shares or whether the entity wants to settle it with the payment of cash. Again, it is a compound financial instrument, right? And does the entity have the present obligation to settle the cash or assets? If the answer is yes, then it is a cash settled. And if the answer is no, then it is a equity settled. So if the entity has decided that it will settle this award with the cash payment, then it will be a cash settled only. So it will be accounted for as cash settled. If the entity doesn't know that they are going to settle it in cash, so, and basis on past experience, they have never settled any such transaction in cash, in that case, it can be regarded as the equity settled, right? So we have to see first from the facts and circumstances of the case, whether the counterparty has the choice or the entity has the choice. If the counterparty has the choice, that would be certainly a compound financial instrument, debt component and equity component, which we need to identify and segregate and account for accordingly. If the entity has the choice, then entity, if chooses for cash, then cash settled. If entity chooses for equity, then equity settled, right? Now, how the fair value will be measured? Counterparty's right to demand payment in cash or other assets. If fair value is measured separately on the date of the receipt and the goods and services, and equity component would be the balancing figure, right? The entity shall recognize the goods and services acquired and the liability to pay for it as applicable to the cash settle. So the journal entry we have been passing for the cash settle transaction will continue to be passed on in this case as well. And the entity shall recognize the goods and services received and increase in equity. So it will be recognized as equity settled in this case, right? So equity component will be recognized like equity settled. Debt component will be recognized like cash settled. And in this case, where the entity has the option, so if entity chooses to pay cash, then cash settled. If entity chooses to pay discharge by issuance of equity shares, then equity settled. Accordingly, the journal entries will be prepared. Choice of settlement in equity instrument has no commercial substance. Entity generally settles in cash or other assets when the counterparty asks for cash settlement. Entity has a past practice or a stated policy of settling in cash or other assets that we need to, check before making a call, right, in practical life. But for your examination purposes anyway, all such facts will be there in the question itself, right? So before I proceed on this question, there is one or two queries. So Munish is asking why full expense charges on the grant date. In the preceding question you are asking, right? So let me go back. Here is the keyword, vest immediately. So question says vest immediately. Vest immediately means all the SARs are vesting to the, counterparty immediately. So all the expense, full expense will be recognized on day one. Full expense will be recognized on day one, right? Because it is vesting immediately without any vesting conditions. So only the delta because of change in fair value will be recognized at each year. Full expense automatically has already been recognized in this case, right? Munish, if I answer your question correctly, and Mr. Anish is saying in cash based settlement example, why we are recognizing entire expense in the first year? Okay, so same question. So Anish, right? So because facts of the question says that vesting is happening immediately on the date of announcement, that is the grant date. So on the grant date, we are recognizing the full expense, and in year 1, 2, 3, we are just, doing the catching up adjustments for the fair value change of that award. In that previous example, we have concluded, right? So good question from both of you. Okay, now let's do this question. And after this question, we will wind up the session for the day, right? Because the next topic will be the modification that we will cover in the next session. On 1st of January 2001, ABC Limited gives options to its key management personnel employees to take either cash equivalent to 1,000 shares or 1,500 shares. So बोल रहे हैं, management is saying that to employees, either you take the cash equivalent to the fair value of 1,000 shares or take 1,500 shares, right? So this is a hybrid because neither entity knows what the employees, will be asking for it. Some employees may ask for cash equivalent of 1,000 shares. Some may ask for 1,500 shares, right? So this is a hybrid now share-based payment arrangement. The minimum service requirement is 2 years and the shares being taken must be kept for 3 years. So service requirement, service condition is 3 years, and the 3 years is the another period after the end of 2 year service condition, that once shares are issued to you, you cannot sell those shares for those 3 years, right? Now, fair values of the shares are as follows. Share alternative fair value with restrictions 102. Grant date fair value on 1st of January 2001 is 113. Fair value of 31st December 2001 is 120. Fair value of December 2002 is 132. The employees exercise their share options at the end of 2002. Pass the journal entries. So now, would you like me to pick this up, or the second question you will pick up, or you would like to pick this up? So as the rule, let me do this, and the next question you do. Now, on 1st of January 2001, okay, equity alternative values at 1500 into 102. What is the 102? 102 is the fair value of share alternative fair value, right? So equity alternative fair value is the 102. And how many shares? 1500 shares. So 1500 shares into May, fair value of those shares. So that is the value which is of equity alternative on the day one, right? How much is the cash alternative? Cash alternative has cash equivalent to the 1000 shares into May 113. Why 113? Because grant date fair value on 1st January for the cash alternative is 113, right? So 113 we will multiply with the 1000 and we will calculate the value of the cash alternative. So this is the equity alternative fair value. This is the cash alternative fair value. Now, equity option or equity is the delta between the two. So 153 minus 113. So 40,000 is the equity component in the entire contract, right? So like we discussed in this chart, that there would be a debt component, there would be a equity component, because the right is sitting with the counterparty, that is employees. Employees can choose whether they want 1500 shares or they want cash equivalent to the fair value of 1000 shares, right? So they have the choice, and it does not have the choice. So there would be two components, debt component, equity components. So we will calculate both the fair values of the equity alternative and the debt alternative, and the delta between the two is the value of the equity, right? Now, year one. Now in the question, because it is said vesting period is 2 years, so life is easy. Year one and year two, right? First year, second year. Now, cash option cumulative. I always said that for the purposes of Ind AS 102, make a thumb rule. Always do the calculations on a cumulative basis and then deduct the preceding period amount recognized in order to arrive at the expense amount for the current year, right? That is the right way to do the calculations. If you use any other shortcuts, you will be, getting the error in the calculation. So cash option cumulative using period and fair value. So 1000 is the number of shares in the cash alternative. 120 is the fair value at the end of the year one. Here it is 120. And at the end of year two, it is 132, right? So 1000 is the cash alternative number of shares. 120 is the fair value. 2 year is the period. So 1 by 2, right? So amount comes to 60,000, right? And here the amount comes to 1,32,000. Why? Because year two fair value is how much? 132. So if I write the calculation here, sorry. Thousand into my 132 into my 2 by 2, right? So 2 by 2 cancelled. 132 into my 1000, 1,32,000. Now equity option cumulative 40,000 into my 1 by 2 and 40,000 into my 2 by 2, because that calculation has already been settled for equity. option, right? So that will not change. So 20,000 will be the amount for year one, and 20,000 will be the amount for year two, right? Because 40,000 is the total amount. Now, expense for the period. Equity option 20,000, equity option 20,000, right? In both the years, the amount will be 20,000, and cash option expense amount is first year 60,000, and second year is 1,32,000 minus 60,000, 72,000. So total amount will be 80,000 for the year one and 92,000 for the year two. So this is the expense amount which will hit the P&L for the year one and year two respectively. Now, how the journal entries will look like in this case? For the year one, employee benefit expense account debit to share-based payment reserve equity account and share-based payment liability account, right? Because we are accounting for now hybrid contract. So recognition of equity option and the cash settlement option. So 80,000 will be the expense, 20,000 will be equity component, 60,000 will be the liability component. In year two, employee benefit expense account debit 92,000, 20,000 again the same expense will be for year two, but for liability it is 72 that we have just calculated right here. 72,000. So 92,000. Now, share-based payment liability account debit to bank account. So 1,32,000 will be settled by payment of cash on the settlement date, and share-based payment equity reserve account debit to retained earnings, because it is not going to be settled. So this will be transferred to the general reserve, 40,000 in this case, because liability has been discharged as the employees claimed the cash option and 132 has already been paid. So no further shares are being issued to them. Hence, no equity account or securities premium account needs to be credited here because there is no issue. But 40,000 will be credited to the retained earnings or the general reserve, right? The equity component recognized 40,000 shall remain within the equity. By electing to receive the cash on the settlement, the employees forfeited the right to receive the equity instruments. If the employee asks for a issue of shares rather than cash, then this entry wouldn't have happened. And we would have passed the journal entry for the issuance of the equity shares rather than passing this 40,000 to the journal. I hope the question is clear. Any questions on this? Calculation, accounting, or any journal entry you might have, any concerns or doubts? Please let me know. If there is none, then in the interest of time, we can quickly see the last question or last item for today's session. And this is the question which you will be solving and, giving me the answers in the chat box. And it will hardly take 5 minutes, nothing more than that. Okay. Tata Industries issued share-based option to one of its key management personnel, which can be exercised either in cash or in equity. And it has the following features, right? So who has the right to ask for cash or equity? The counterparty, right? The counterparty has the right. Now, option one, number of shares, settled shares. 74,000 is the number of shares. Service condition is 3 years. Option two, number of shares of the face value of rupees 100. 90,000 would be the number of shares which will be given. Now, service condition is again 3 years, and the restriction to sell those shares is 2 years after they receive the shares in their demat accounts, right? Now, fair values are given for the sale of 2 years. Fair value on the grant date is how much? 135, and equity price with the restriction fair value is 115, and fair values on subsequent dates 2010, 11 and 12 is 138, 140, and 147. So pass the journal entries. So instead of passing the journal entries, you simply calculate the expense amount for the year 1, 2, and 3, and just, give me the answer in the chat box. So if you are able to calculate the amounts correctly, passing a journal entry wouldn't be a big deal. Key is to calculate the amounts correctly. Meantime, you are doing the calculations. I'm just taking one of the query Mr. Mohammed has asked for the preceding question. Sir, what will be the entry if the equity is issued? That we will see in this question. So just focus on this question, come up with the solution answer of the expense, and then we will discuss the journal entries, and then we will wind up the sessions. So as quickly as you respond, session will be over. Any luck? Somebody might have calculated. So Mr. Mohammed has reverted equity component 3 lakh and 60,000. Okay. Let's see. So fair value of the equity option components. Okay. Fair value of the share with the restrictive clause is how much given in the question 115. Number of shares is how much under the equity option 90,000. So fair value would be 90,000 into my 115, that is 103 1 crore 3 lakh and 50,000. So that is the fair value. Now fair value of share at the grant date. Number of cash settled shares, how much? 74,000 shares into my fair value is how much? 135. So 99 lakhs 90,000, right? So fair value of the equity component in the compound instrument A minus B is 3 lakh 60,000. So far, so good, Muhammad Abdul. You reached to the correct calculation. What's next? How much would be the expense in year 1, 2, and 3? I can definitely discuss the solution, but I just want you to, do some calculations yourself first so that you know if there is any error you are, incurring while calculations. Anji, what's next? Okay, let's see. On 31st March 2010, what would be the amount and the entry? Employee benefit expense account debit. So that is for sure whether the it is equity settled or the cash settled or the hybrid. Anyway, the expense will be debited, right? So employee benefit expense debited, and to share based payment reserve equity account and to share based payment liability account, because we are accounting for the hybrid. So there will be two credits. One is for the equity component, another is for the liability component, right? Like we have, seen in the previous example. Now, how these amounts are arrived? So 3,60,000 is the equity component and 3 years is the service condition or service period or the vesting period. So 3,60,000 divided by 3, simply 1,20,000 would be the equity component credited every year, right? And this will not change throughout the vesting period, correct? Because equity component never changes. Only liability component will be changed in lieu of change in the fair value, right? So 138 into 74,000 divided by 3. How much? 34 lakhs 4,000, right? So the total expense comes to 35 lakhs 24,000 by adding these two items, right? Now, in next year, again, entry will be the same, amounts will be the different. So 1,20,000 will remain constant because it is a equity component, and the liability component we will calculate like this. 140 is the year to fair value, number of shares under the cash option into 2 by 3 minus the previous expense. So this is the expense, and the total of these two will hit to the employee benefit expense P&L. On the year 3, entry will again be the same. So 1,20,000 will be the equity component, and the calculation for the third year would be the new fair value into my number of shares into my 3 by 3 minus year 1 recognition and year 2 recognition of expense, right? So 13,971. So total of these will hit to the employee benefit expense P&L account, right? Now, if cash alternative is chosen and if equity alternative is chosen, what would be the journal entries? So number of upon cash alternative chosen, share based payment liability is 147 into 74,000. This much to bank or cash. Now this 147 is given in the question. Here it is. Right? Year 3 fair value. Settlement is happening on the same date, right? So this much would be the cash which will be discharged, right, under the cash alternative option if chosen by the counterparty, that is employees in our example. And because we have settled through cash, so share based payment reserve equity account to retained earnings, 3,60,000, right? All the 1,20,000 into 3 for the 3 years will go to the retained earnings, right? Because no shares are being issued in this case because settlement is demanded by payment of cash, correct? Now, if equity alternative is chosen, then share based payment liability account debit by how much? 1,08,7,800 to the share capital 90 lakhs, and to the securities premium 18 lakh 78,000. How this is calculated? So we are discharging how much amount? 1 crore 8 lakh and 78,000, right? And how many shares are supposed to be issued under the equity option is the 90,000 shares. So 90,000 shares at a face value of rupees 10 or 100 given in the question, 90,000 into my 100. So this would be this equity share capital account credit, and this minus this is the securities premium account, right? And again, the share-based payment reserve equity account, the 3,60,000 for the equity component we had accumulated over the 3-year period will again go to the security premium account only, 3,60,000, right? Being transferred from one equity from one account to the another account. So this is how the accounting entry would be for equity alternative, and this is how the accounting entry would be for the cash alternative. Sorted? No problem, Munish. I understood your point. Okay, so just let me know if you have any questions, queries, or doubts on any of the three types or categories of the share-based payment awards we have discussed so far. And if there are none, just ping quickly in the chat box that it is clear, so that I come to know, and we can wind up the session for the day. Okay, so Manisha is asking, securities premium is the balancing figure. Correct. That's right. Muhammad Abdul is asking, sir, what is the use of share-based payment reserve equity? So use of share-based payment reserve equity is only for the equity component. Once the clarity emerges whether this is being settled through cash or equity, it goes to the general reserve or retained earnings. And Mr. Munish is saying, my query is remaining to be answered. Okay, the previous query, now, which I had parked to pick up at the end of the session, right? So your query was, where it is? Before the break, you had asked something, no? Then after the break, I said I will be taking it up at the end. I'm just trying to find what was that query. Okay, I got it. So when I was discussing the concept of reload feature, you asked that means he need to surrender previously issued shares, right? That was your query. So in that case, yes. So in the reload feature, what I have said, to discharge the obligation of the exercise price on the exercise date by the employee has two choices. Either he can discharge by paying in cash the exercise price, or he can surrender equivalent value of equity shares already granted to him, right? So that was the correct uh, understanding. So I think there are no queries coming up in the chat box. So should I assume that we are good to go and happy to end the session for the day? Okay. Thank you all for listening me patiently, and I hope the session was, value add and informative for all of you. You must have enjoyed the session. With this note, I am just logging off, and we'll see you in the next session. And we will complete the standard on our next session. Thank you.